My name is Brett Lyman. I am one of three brothers who founded LymanWealth LLC. We've been in business since early 2021. We're all engineers. We don't have finance degrees, so we look at the world a little bit differently. In fact, we have something hardwired in our brains to where we're skeptical about just about everything. So you're going to see that play out in this presentation. I've been a software engineer for a little over 25 years. Most of my career has been in data modeling and data analytics. I have a patent for a data compression algorithm that we used in artificial intelligence, but we're not here to talk about me. 65% return was our consolidated return across our client accounts in 2024. Just for reference, the S&P 500 return was just shy of 25%. So how did we achieve over 40% higher than the S&P did last year? First, let's level set on some definitions. Alpha is generally regarded as your excess return above and beyond your risk-adjusted expected return. Most people use the CAPM formula for determining your expected return, but that's what we're going to use for its familiarity in this presentation. A big component of the CAPM formula is actually your beta. Beta is a measure that people typically regard as risk. It's actually the risk of the volatility against a benchmark. So it's the risk of deviation from that benchmark. The CAPM formula has two major components. First is your expected return as it regards your risk. Your beta score is a multiplier of a market return combined with risk-free rate to determine what's your expected return given the level of risk you had to assume for your investment. You subtract that from your actual investment return to see how you did, right? So this is the CAPM version of calculating alpha. If your expected return was really high because you took on a lot of risk and you did not compensate for it in your actual return, your alpha will be negative. It'll be less than zero. However, if your return was high enough to compensate for the risk you had to assume for whatever strategy you're using, you'll have a positive alpha. That's what we're focusing on in this presentation. This is a chart of the S&P 500 since 1928. I know a lot of you have seen this chart. This is on a log scale to unwind the compounding. The S&P 500 index has returned on average a little over 10% per year in a compound fashion since inception in 1928. It is an over 90-year trend of doing that. As engineers, I mentioned, we're skeptical about everything, most especially what goes on in the market. But this, that's double my lifetime of doing what it does. That's something we can get behind. And it's actually one of the only things that we allow ourselves to assume about the market is that we expect the indexes to continue doing what they've done for over 90 years. So this is the foundation of our strategy. It's index investing at its core. However, to generate alpha, you've got to do something special, right? So what we're going to do is we're going to take the index and we're going to do something interesting with the volatility of the index. And we're going to get into the details here, but here's a pro tip real quick. There are leveraged ETFs that track the indices that amplify their volatility. So you get exposure to the index. You can invest in the index, but with amplified volatility. And I know what you're thinking. That's higher beta. That's higher risk. Yes, it is. We're going to use that to our advantage. So what's the big idea? If you're investing in an index you expect will go up long term, you can actually use a leveraged version of its volatility to produce alpha. So here's a visual version of that. Take your leveraged index volatility, feed it into some sort of a strategy where you can capture and compound it. Harvest that volatility. The output would be alpha. So what is this thing that we're feeding it into? We call it Quantelligent investing. The first component is dollar cost averaging. The actual formula for dollar cost averaging is a fixed amount on a regular schedule. What that allows you to do is pick up units at a lower price when it dips. The effect that this has on your investment is that it brings your average down. Every time it dips, it's bringing your average down, which is great because investing in a market in a long fashion is all about buying low. So we love dollar cost averaging because it tells you when to buy. It tells you how to build a position with a lower average price, guaranteed to be lower than the relative maximum when you started. Okay, so we're talking about harvesting volatility, right? We're talking about capturing and compounding volatility. Dollar cost averaging only tells you when to buy. There's no exit component to dollar cost averaging. It only builds your position. So that's where the second piece comes in. Value averaging is a little bit lesser known than dollar cost averaging. However, it has a lot of similarities. You're investing in a fixed schedule every period, but value averaging says you should adjust your contribution amount based on the value change of your position since the previous period. In other words, if the market for your instrument, whatever you're investing in, has gone up and the value of your position has gone up, you can actually contribute a little bit less because you're using a value growth target. So if the market goes up and your position goes up in value, you can reduce your contribution to get it to that growth target. However, if the market has gone down and the value of your position has gone away from your growth target, you have to contribute more to bring it back up to that growth target. I do want to dwell on this for a second because value averaging we've actually found in all of our testing to be way too aggressive when you have a bear market. The amount that you have to contribute to bring it back up to that growth target can multiply exponentially. And so we don't like the buy side of value averaging because it's way too aggressive. However, there's a very interesting thing that happens with value averaging on the top side. If the value of your position has gone up towards your growth target, but not just towards it, but has exceeded, value averaging says sell some of your position. So you actually get to exit some of your position if there's too much growth above and beyond the value growth target. That's what we've been looking for. This gives us an exit component. You couple that with the buys from dollar cost averaging with those value growth targets so that you can exit when it grows too much. Now we have a complete formula for capturing and compounding local volatility. So let's take a look at what this looks like on an illustration. First component is your dollar cost averaging. Dollar cost averaging, you would just buy every period regardless of price, which includes the dips, also includes all of the periods, right? That's traditional dollar cost averaging. Now watch what happens when we add value averaging into our strategy, but just the top side, mind you. When the price of the instrument you're investing in exceeds your average price enough to exceed that value growth target, it converts that investment period into a partial sell. And there's a third component. We're investing in an index. We're doing this harvesting thing. We're going to capture and compound those local waves. As we do that, we're growing. When we hit a growth goal, a long-term growth goal, you should capture it, your entire position. Exit it. Start this process over again. So the main insight here is when you combine the buys from dollar cost averaging with the captures, that value growth exit from value averaging as your sells, you've got a formula with a built-in buy low, sell high, but without timing the market. We've got a built-in buy low, sell high happening regularly. Practical implementation requires answers to a lot of questions. Which indexes? How frequent am I doing this? What amount of leverage should I use? What about those growth targets? There are a lot of questions, right? There are a lot of details here. Back to being a skeptical engineer. We're not going to tell you. And the reason is we don't like magic numbers. There's no magic number that says, here's how you trade this every time, and it works with every instrument. We actually don't believe it when someone says something like that. Also, every investor is different. Every investor has different levels, different comfort levels with risk and aggressiveness. What we like to suggest is be intelligent about it by using quantitative analysis to determine your setup that works for you. You see where we got our name for this strategy, right? We call it being Quantelligent or Quantelligent investing. So you can take this information home, go do some of your quantitative analysis, run some different setups, run some different indexes, run some different levels of leverage, test your dollar cost averaging frequencies and so on and so forth. Make it yours. See what results you get. I think you'll see that it's pretty cool what comes out of doing that. So to help you in your journey, we're going to show you how we approach this, our journey to get to where we are with this 65% return. So if you're like me average middle-class American with an unfinished basement, you probably have stacks of computers down there that you play with on weekends, right? No, I'm the only one. This is how we got started 6 or 7 years ago. When we started doing modeling of financial data, we found that spreadsheets can only take you so far, right? We were doing spreadsheets and pivot tables. We wanted to do a more exhaustive search of different indexes, different ETFs, different variations of this type of strategy. So we use distributed computing to do that. And what we do is we test different ETFs, different ranges. Remember, there were 3 components in that illustration: the dollar cost averaging, the second part, value averaging targets. And then that third one, test different ranges of that long-term growth goal. You could run all of those permutations of all of those setups, dump it into a spreadsheet, sort by most profitable, and pick the top one. That's a fallacy. At least in the data mining world, we call that overfitting your model. Because that top result could just be lucky, right? It happened to exit right before it crashed so that you had all this capital going into the downturn. We don't want luck to play into this. So we have 3 parameters that we're testing ranges on, 3 axes. This is how we visualize the results from that permutative analysis. This represents maybe like 40,000 different versions of Quantelligent investing plotted in a 3D space so that we can spatially explore the results. Now we can twist it and turn it, and we can look for a pocket of profitability like this one. That's important. This is how we prevent the overfitting of the model. This is how we prevent picking a lucky setup, right? If you put it in a spreadsheet and pick that top one, that could have just been lucky. So this pocket of profitability allows us to pick a setup somewhere in the middle of that pocket. Now the market behavior going forward can deviate from the model in one parameter or another parameter, or all 3 parameters, because it's a pocket, right? There's room for the market to behave a little bit differently than what you've modeled. And if we're still within that pocket, your future results are very closely going to match your modeled results. So once we pick a setup within that pocket of profitability, we're going to look at it by itself and see how it would have done historically if we had traded it over the lifetime of that ETF that tracks the index. In this example, we're using SPXL. SPXL, if you're not familiar, is a 3x leveraged ETF tracking the S&P 500. So we're going to look at this setup and see how a setup that we picked in that pocket of profitability would have done since the beginning of SPXL, since November of 2008. The S&P 500 has achieved roughly a compound annual growth rate of about 11%. The orange mountain that you can see in here, that's SPXL. By itself would have had a compound annual growth rate of about 25.5%, but your beta is 3. Like I mentioned, it's a 3x leveraged ETF. And that's your volatility score, right? So if I trace the outline of your experience buying and holding this leveraged ETF, it's a roller coaster. Those kinds of ups and downs are probably going to take some years off of your life. I would not like that roller coaster ride, especially if I'm investing a significant amount of money or investing for retirement. So what happens when we apply Quantelligent to this leveraged ETF from 2008? Remember, we picked a setup within that pocket of profitability. Now we're going to see what it would have done with this instrument. Okay, we still have a compound annual growth rate, about the same as the leveraged ETF, 25.5%. But our beta was only 1.35. And what's better? What happened to that roller coaster? That is a launching ramp of exponential growth into retirement or the sunset or whatever it is you're going for. This smooth line feels so much better to me than that roller coaster from before. So for achieving roughly the same amount of return per year, but with a lower beta, are we producing alpha? Have we unlocked alpha? Go back to our CAPM formula that we introduced at the beginning. We're unlocking alpha. So these are the numbers from the previous slide. Our investments return 25.5. The S&P is our benchmark for this one, 11% per year. The average risk-free rate was 2.5, and our average beta exposure is 1.35. If we assume that we can use the CAPM model for this style of investing, this would be our alpha. Did we achieve positive? Double digits positive? If this holds true, we have unlocked double-digit positive alpha on an annual basis with this model. Okay, I know what you're thinking. That's a back test. Anybody can produce a good-looking back test, and you're right. So, 2024, great year for the market. S&P 500 returned 25%. But let's use semiconductors. So that old adage of everybody looks like a genius in a bull market, we're going to use semiconductors because it didn't have such a great year last year. This is what semiconductor index did in 2024. If you were a buy and hold investor in 2024 with this leveraged ETF, minus 12% by the end. Let's put Quantelligent to work on this. Okay, so these are actual trades from one of our clients. The dollar cost averaging buys are represented by blue dots. We're doing this on a daily basis. So our default action every day is to buy more into the position. However, if the price spikes up above our average price is this pink line. I don't know if you can see it there. If it spikes up enough to exceed the value growth target, that's when you have an exit. These green diamonds are value averaging, exceeded the target. We're going to sell some of our position. Every time there's a green diamond, we're capturing a bit of profit. And then that long-term growth goal, those are represented by these yellow triangles. Two of them in this year where the instrument went down 12%. Obviously, there's a lot of volatility in there, and that's what we're talking about. Harvest that volatility to generate growth. I want to focus on those because this is proof of the point. If you were timing the market, your growth captures would have to be at peaks. These are not. These are actually at very relatively low points in the price graph. We generated growth off of the volatility and hit the growth goals at relatively low points. In fact, the second one is lower than the first one. So if you were a buy and hold investor between those 2 points, this is about 7 months. If you were buy and hold, you went down 23%. How much growth did we generate for this client in this time frame? It was positive 27% growth. So then, back to our title slide. Are we unlocking positive alpha? For this window of time, this specific customer, this was unlocking not just double-digit alpha, but 26 alpha for this client. That's the power of this style of investing. Thank you.